All right, so there you have the Reserve Bank of India governor delivering the 50 basis point rate hike that the market had widely factored in. The stance has been left unchanged at withdrawal of accommodation. As far as the inflation forecasts are concerned, largely unchanged with a few tweaks really that we've seen in the third quarter, a slight upward revision by 10 basis points to 6.5%. Other than that, the inflation forecast has also largely been left unchanged. On the growth front, it has been lowered again as expected because of mathematical arithmetical reasons. The first quarter numbers were lower than what RBI had factored in, so now it has been adjusted from 7.2% to 7% for the full fiscal year. Let me quickly toss it across to Lata, who's also there with her analysis.
Well, actually, entirely on expected lines. The rupee has fallen a bit, but I think that's more global adjustments. The bond yields have perked up a bit, and I think that could be in response to the stance not being changed. Perhaps there were some people expecting calibrated tightening. Since that has not happened, that perhaps is seen as positive. As well, the inflation forecast has not been raised or tinkered with very seriously. So all that is adding to the confidence of the market. The stock market itself, of course, is very, very cheerful. At this point in time, we're seeing a decent amount of recovery over there, but that, of course, would be a mix of so many factors. The point is, it's entirely on expected lines. Let me toss it to our guests. Kaushik, first up, any surprises for you at all? What would be the most important takeaway?
So, Lata, the good thing is that unlike the other central banks across the world, RBI has decided not to surprise and just go along the expected lines, which in a way is a good thing in the current volatile environment. That whatever market was expecting, we got that 50 basis point hike. Inflation forecast unchanged, growth forecast lowered, but lowered to only 7%. And on liquidity, RBI is saying that they'll kind of fine-tune operations and make sure that things are not overly tight. So I guess the big takeaway is that RBI will go from policy to policy and decide, looking at global environment, what to do. I think there are more rate hikes coming in December and probably in February if inflation doesn't come down. A couple of things. You see on growth forecast, RBI has actually increased the second half growth forecast from 4% average to 4.6, which is more realistic. And I think that's why the 7% growth has come. It is not just kind of the April-June number that has come down, obviously, but July-September growth also has been kept more or less 6.2, has gone up to 6.3. But the second half, RBI was at 4%, that has been raised to 4.6. On inflation, RBI has not given the July-September number for next year. I'm not sure whether it is there in the statement, but as of now, Governor has talked about 5% in April-June. There has been a little bit increase, as Ritu mentioned, that October-December 6.4 has gone up to 6.5, but there could be some upside risk for that quarter because cereals inflation, vegetable prices are going up, and you could end up with a higher inflation, and therefore the 5.8% forecast for January-March, that could be also slightly on the higher side. But as of now, this is a good policy which kind of gives a lot of certainty to the market, and they can move on from here and then decide next policy in December what they need to do.
Yeah, okay. Kaushik, if you can keep the first comments brief, because we have a lot of people to give their comments. Let me toss it to Mr. Alok Choudhary. Mr. Choudhary, 50 basis coming straight away. Now, they haven't spoken much about providing additional liquidity, except that the 28-day VRRR and the 14-day VRRR will be merged. I will get to the market experts on that announcement. But are you expecting that deposit rates have to go up now?
See, there can be some calibration because the interest rates on advances, because of the EBLR pass-through will happen. So there could be, and as of now, as we understand, that the rate of deposit growth is almost 9.5% and advances growth growing to 16.2%. There is already some kind of pressure on deposits. So banks, as per their asset liability mismatches and their growth prospects in credit, they will do some tweaking maybe in the coming days.
Okay. Yeah, I mean, your lending rates are going up straight away by 0.5 percentage point, and therefore perhaps there is no elbow room as well to increase deposits. Actually, on liquidity, it's a bit ambivalent. they have retained withdrawal of accommodation, and it is not very clear whether they are okay if the repo rate is the ruling rate on several occasions. Ashhish, Vaidya, what have you made of the entire combination? Do you think the call rate will continue to hug 6% and 5.9 now?
Yeah, good morning, Lata. I think the RBI policy completely on expected lines. On the liquidity, I think important to note that the governor talks about a lot of dislocations that are happening, and clearly driven by that a sort of taper tantrum or the dollar index going where it is. So I think it's very hard to define on liquidity how exactly it will pan out. It's clearly going to be on a reducing mode given festive season, demand also coming up, etc., which will result in cash withdrawal from the system. So I think that it's sort of giving the right picture to the market, and I think it's the right way to play out by the central bank. So you are having the markets, the increase in rates as per what the market wanted. On liquidity, he's been a bit cautious, which is actually the fact, because you really don't know how much of liquidity will go out because of the dollar intervention, which they might have to do, because the dislocation continues into November and December. It could get quite murky. So I think it's a very balanced judgment. Now the market will have to take it from here.
Yes. Yeah. Upasna, what did you make? You were expecting that, you were one of the few people who explicitly said that you expect that the interbank rate will move towards repo. It already has whenever there is a deficit. What have you made of the rates? It's just that 50 basis, yes. But on liquidity, do you think the actual rise in rates in the market is going to be more?
Clearly, Lata, one is, of course, on the repo rate front, which is on expected line. Two, I think the overall statement guidance is fairly balanced. I mean, that is one thing which probably was not expected given the adverse global conditions. But the governor has managed to balance out the risks and the positives and the negatives to provide a fairly balanced approach here, which also kind of suggests that going ahead, the decisions are going to be fairly data dependent. It will be a function of global cues, but also the domestic development on the inflation side largely. I would concur with we were not expecting any revisions to the inflation estimates in any case. We are anyway softer on inflation in the H1 calendar year next year compared to RBI. We do expect that some of the lagged impact of monetary tightness and the slower commodity prices will start seeping in. So we do remain cautious there. So in all of this, of course, the bigger point here is on the liquidity side. The weighted average call rates have to hover around repo, slightly higher than the repo rate probably for some more time. One aspect on liquidity which the governor has been highlighting is that in the coming few months, we do expect that the government will start spending and liquidity will probably improve. But if we look at the core liquidity, the durable liquidity, that is around 3.5 lakh crore. And that is probably one aspect where we need to keep in mind. The accommodation still remains. Once that is approaching zero or neutral territory is where the overall system-wide, we will get a policy stance which will be neutral. So I think that's where the convergence will happen. And we do expect that the liquidity will tighten going ahead, durable liquidity, moving more towards neutrality by the end of the year, largely because the currency leakage will be offsetting the government spending.
Yeah. Yeah, absolutely. The only problem is that some of this liquidity is with the state governments and they may not be spending as rapidly. So while it may show that there is core liquidity, the banking system is in deficit. On that point, Mr. Choudhary, first on the raising of the rates, what percentage of your loans are externally benchmarked? And therefore, do you expect that this 50 bips, one-shot rise in interest rates for the retail sector can lead to some dampening of demand?
See, we have been seeing the increase in rate almost 140 bips we have seen in the EVLR, almost 40% of the debt to retail as well as MSME that is linked to EVLR. Leaving aside the MCLR part, which is a different calculation, But still, the market has been able to absorb. The demand has been quite robust, so to say, because we've seen in the numbers of whether it is agriculture or SME or say retail, the market has or the demand has probably factored in this increase. And I understand that this will not dampen the demand, more so in this festive season, because banks have come out with their own sweeteners in terms of concessions. And we are seeing the daily numbers, which do not give me any, say, negative downside to this particular increase in rates.
Okay. Okay. What about deposit rates again, Mr. Choudhary? I'm coming back to it because from what the governor said, it doesn't look that they are very keen to provide too much liquidity. We will know, of course, more in the press conference. It looks like they are okay if intermittently the repo rate is the ruling rate and not anything like the reverse repo. Do you think banks will be perforce, forced to hike deposit rates because, of this interbank liquidity deficit? And in that case, there will be an impact on margins, won't there?
I think there are a couple of things. One, the hike in deposit rates is something which looks very linear, but he also said that the extra CRR and SLR which the banks have, so they can also bank on that for feeding their credit. And as far as deposit rates are concerned, Lata, will find that the deposit rates in the last, say, 4 or 5 months have already, the median rates have already increased by more than 25 bips almost. And as far as bulk rates are concerned, the bulk rates have been moving up. Almost all banks have increased their card rates, but more so from card rates, the differential interest rates which are being provided on a case-to-case basis, that has also hotted up that bulk rate space. As far as retail is concerned, which is quite a significant portion of the bank's deposits, they are also in certain, say, 1 to 2 year or 2 to 3 year bucket, which is the major bucket. So there the banks have also increased rates. Of course, different banks have different rates, but generally all banks have increased the rates. So protecting the NIM on the one side, but
so
also
more generally, sir.
Yeah. Yeah, Lata.
Yeah, so more generally, are you expecting in Q3 margins could get tighter for banks?
Margins may not get tighter for the banks because we also see that in case of loans, the type of concessions which are being provided earlier, there has been some kind of more, say, prudence on risk pricing of loan accounts. So I think it will move in tandem and banks will try to protect their NIMs and taking care of their deposits either by increasing the rates or also by drawing upon their extra SLR balance.
Okay. Fair enough, fair enough. I mean, banks like you can have some SLR elbow room. I don't think many of the private sector banks have that. Sivakumar, 4.38 after the government announced, after the RBI announced its policy. Actually, yields have inched down a bit. What do you see as the 10-year rate, say, in a month from now?
Yeah, hi. So the most important thing is exactly in line with expectation and no surprises on any count, right? So I think that's the reason why market reaction has been relatively muted, and I expect the same to continue unless we get some dramatic new development. Now, a fair amount of future rate hikes are also priced in. So in that sense, at least for the near term, we should expect relative stability. Relative stability means plus or minus 10 or 20 basis points in a month is not really a surprise as we have seen in the last few months. But we should expect relative stability and no major biases. We really don't expect any major biases certainly to the upside at this point in time.
Upasna, aside from some of these headline numbers, on liquidity, we haven't heard much. Some fine-tuning of operations as required. It's taken note of the deficit. It's merged the, RBI has said it'll merge the 28-day VRRR with the 14-day VRRR. Doesn't really move the needle much.
I think here we need to keep in mind that naturally the system liquidity has been getting drained out. Until the government doesn't start spending, this will remain the case going ahead. And like I said before, the CIC leakage is also going to be continuously draining liquidity. So there's not, so one is RBI's objective, because they would prefer the weighted average call rate to hover around repo rate or maybe marginally higher. That is the pre-pandemic levels, and that is the MPC's mandate as well. So that is where exactly RBI wants situation to be. They would not want to provide any liquidity easing measures at this juncture. But yes, how they can really ensure that this happens and without really causing any frictional problems is through repo operations, and that they have announced. The governor did mention that they will conduct repo operations as and when required, variable repo operations.
Yeah. Mr. Choudhary, there's a couple of non-policy measures we have not addressed just yet. One is the discussion paper on the loan loss provisioning by banks, where RBI is indicating don't provide for NPAs after they've become NPAs, but more accelerated ECL kind of, you take that into account before you factor in. The second is a discussion paper on securitization of stressed assets. While we don't know the details of these just yet, we're awaiting those from RBI. Your initial thoughts?
Yeah, so see, as far as the expected loss provision is concerned, you are aware that for the last couple of years, the implementation of Ind AS on the banks has been deferred because of the situations, COVID, etc. So the banks have already been doing this kind of exercise, and they have been sending the reports to RBI on stipulated intervals. So banks are aware of the expected credit loss which is going to happen. And now it's a question of implementation date as to when it happens. And as we see the fine print and the details, we will be able to get more sense out of it. But for the banks, it will not be new, at least for the internal workings which the banks have as of now. As far as securitization, I think let's wait for the discussion paper to come in order to make some comments on this.
Okay. Point taken, Mr. Choudhary. Yes, this looks like the first step towards adopting Ind AS, and also it's a very sensible time to adopt it, because this is the time bank balance sheets have gotten cleaned up. They're extremely strong, and therefore to start expected loss provisioning right now seems absolutely the best time to do it. If you want to make a start, do it when banks are in fine fettle. My only problem is the word discussion paper. Normally, when a discussion paper is issued, it takes a very long time for the ultimate, rules to come through. So we have to see if this may not be the most hurried thing on the mind of the Reserve Bank. Thank you very much, Mr. Choudhary, for joining us with your initial thoughts. Just a technicality on this 14-day and 28-day. I just wanted both the market experts to talk about it. Just give us a quick comment. Sivakumar, is it going to make a big difference, this 28-day, before Sivakumar, let me come to Ashhish, since he's the banker. Ashhish, is going to make a big difference?
No, not at all. I think it's just substituting the 28 days with the 14 days, right? So it doesn't really make a difference. I think it's absolutely fine. I think what he's really trying to do is probably, market may not be able to forecast funds for 28 days. So because the liquidity situation is a little tighter, right? So it's best that they basically suck out liquidity via the 14 days. That's the only thing.
Yeah. Actually, if you looked at the auctions, all of them are the results are at the same level. So it's very clear that if the RBI wanted a curve, that's not happening, because people are not able to forecast liquidity any differently. Sivakumar, any guess why the yields have fallen so much after the policy? I mean, we started the day at 7.4, now at 7.34. Any specific reason that, 3.5 at the moment, that the market is so cheered?
I think, first of all, no surprises. There were some people who were expecting perhaps a little bit more than 50. So 50 was a base expectation. There was some expectation perhaps there would have been, let's say, 60, just to take it to a round number of 6% on the repo rate. And given what the Fed and other banks, central banks have been doing, it may have a potential risk of a higher number. So the fact that they did 50, I think, is a bit of a comfort. The fact that they have not done anything else in terms of policy, I think, is also a bit of a comfort. One point on this liquidity is very important, I think, is that there was also money market expected that they might do something in terms of giving guidance on liquidity, given how liquidity has become so tight. And so I do expect money market rates to remain somewhat hard in the near term. So while we have seen the 10-year GSEC yields have dropped a little bit, my expectation is that money markets will expect the liquidity to be significantly tighter going forward. To also go back to your earlier question about this 28-day, clearly, as you move from surplus liquidity to a neutral to a tight liquidity environment, there's no need for 28-day variable rate reverse repos. See, the reverse repos will become less and less important as the market moves into repo mode. So over a period of time, my expectation is that the 14-day repo becomes relevant from a net liquidity injection. And if liquidity becomes that much negative, then obviously they could look at other tenors for repo. I think over the next few months, we should expect the system to be completely flipped into a negative net liquidity environment, and the reverse repo will be far less important in that situation.
All right. Quick word from all of you before we wrap on, what you're expecting going ahead. Starting with you, Kaushik. Where do you see, the peak repo rates with the new information that you have after this policy, and how swiftly or slowly do you think RBI will move now?
So we have a 35 basis point rate hike in December because we expect Fed to go another 75 in November and 50 in December. We think minimum 35 is required in December from RBI, which will take it up to 6 quarters. And that is what the terminal rate that we are forecasting, although we would prefer the terminal rate to go up to 650, looking at various parameters. Okay, 650 is your number. Upasna, you?
As of now, 35 basis until December, so 6 quarter. And I think February, there will be some room for RBI to pause and assess the monetary tightness that has happened and its impact overall on the inflation trajectory. So we remain at 6 quarter for now.
Ashhish, any final comments then?
So I have a sense that inflation will remain sticky for a little bit longer, given that the low-cost labor supply, which is coming from China, is sort of gone away. The diversified supply chain is again gone away. The cheap, energy prices again sort of in a limbo. So I think that the neutral rates would be, at least my sense would be somewhere about 6.5 to 6.75, because rates, the inflation will remain much more stickier for longer, is my sense.
Okay. Thank you very much, Mr. Choudhary, Ashhish, Upasna, Kaushik, and Sivakumar for giving us your initial discussions. You will have to say that it's an as-expected policy, and all markets are firing positively because of perhaps no nasty surprise policy. The bond markets are absolutely cheerful. We've seen a 5 basis point fall, but then it's only in the 10-year. It's not across the board. It's the stock markets that have really cheered the policy. It is 1.5% gain on the bank Nifty itself. I mean, that's pretty cheerful. So that's the sigh of relief perhaps that the stock markets are giving at this point in time. Happy that there are no nasty surprises. From Ritu and myself, thank you very much for watching this special coming straight from Mint Street on the monetary policy. We will regroup at 12 noon when the governor will be addressing a press conference. Going to a break now, and then it will be markets, stock markets all the way. They're very cheerful.